of the most easy to understand and globally traded option strategies, but not very popular in India. It's a covered call strategy. In fact, even with the very active trading community that we have in this channel, I don't think a lot of people know about this strategy at all, or they might have heard about it but not really processed or appreciated the way it works. So the covered call system, it is nothing but a rental yield system, right? That's how I'm thinking of it. So when we deployed the strategy, how we thought of is what I'll tell you here in the introduction. So for the covered call strategy to work, you have to buy a really fundamentally good stock, right? That's the basic of it. So once we've invested into that stock, we imagined it to be sort of like a commercial property, right? And in a commercial property, what do you need? You need some dividends as profits, and you need some rental income as well. And that is when we stumbled into this entire strategy. So yes, what are you waiting for? If you're looking for a strategy which is traded by a lot of HNIs, high net worth individuals, or something if you're looking for a commercial property and you want a stock market alternative to it, where you do not have to take a trade every day, where you do not even have to look at a screen or monitor your active trades at all, then yes, covered call strategy might be working for you. So yes, this is Ajay Ajith. Welcome to Market Feed. So before getting started, let's discuss the structure of the video and how it will look like. First, we'll discuss what a call option is, what is buying a call option, what is selling a call option in very easy terms. We'll explain it in less than 2 minutes. After that, we'll go into the exact strategy that we deployed and how we are seeing it as an opportunity for rental income. And then we'll go through the entire strategy itself and we'll have a look at the pros and cons of the strategy. As any stock market strategy, there will be a pro and a con. But trust me, this one has more pros than it has cons. So before getting into what a covered call is, let us look at what that call is, right? A call or a call option is nothing but a derivative contract. Let's take this example. You're trying to buy a used car. So in that journey of buying a used car, you're going to various sellers here and there and you're trying to individually negotiate deals with them. So you as a buyer, you want to go and negotiate terms with each and every one of them, find the best car, then only buy it, right? So you as a buyer, you want that, or you have that freedom, right? So what would you do? You would design a contract with that car seller so that whenever, let's say at the end of the month, you're promising that person that at the end of the month, I'll come and buy the car if I want to, and for the right to buy that car if I want to, right? Only if I decide, hey, I looked at 10 cars and only if I want to buy your car, I'll come at the end of the month. And if I want to buy that car, I'll come and pay the full amount that we are agreeing now, right? So what all happened here? There's a predetermined price, right? I already agreed the price in which I'm going to buy that car. I already agreed the time at which I'm going to come and buy that car. But I, as a buyer, I have the option or the right to buy. And for this right to buy, I'll pay him a token amount, or in the case of options, I'll pay him a premium amount, right? So I'm paying him a premium and writing a contract so that if at the end of the month that is the best car that I want to buy, I can go to that person and I can buy the car. But my contract is designed in a way that the seller has to sell me that car if I go and ask for it, right? That is very simple. I have paid him a token or a premium or an advance amount, and if I go to buy it, he has to sell it. If I go and decide to buy that car by the end of the month, I have to pay in the full amount. I already paid the premium, right? And I have to pay him the extra or the entire car's amount as well, and I can buy the car. And if I don't go there, if I don't go to buy that car, that entire premium amount is his, right? The seller can keep the entire premium amount. And this is broadly how a call option works. The call option buyer has a right to buy, and the option seller, the call option seller here, has an obligation to sell. And for this contract which they are entering into, there is a premium amount being exchanged, there is a set time in which they are saying that the transaction will occur, and there is a set date also wherein they are agreeing by the end of the month I'll come and complete this transaction. So there is a set premium, there is a set price, as well as there is a set date as well when the transaction will occur. So quickly coming into the world of the stock market as well, let's say you're going to buy a call option of HDFC Bank at 1700, right? So if you're buying a contract of HDFC Bank at 1700, there will be an expiry date for that option as well. You might see it as May 2024 right now. And if you're buying that contract, what does that mean? You as a buyer of that contract of HDFC Bank 1700 CE, which is a HDFC Bank call option, you have a right to buy HDFC Bank at the end of 2024 May at the price of 1700. okay, and you have the right to buy. And the seller, on the other hand, if you're going there to demand, you're saying that I want to buy this option, then the seller has to sell you HDFC Bank at 1700. Now imagine, when will you exercise this contract? When will you go to buy? When the market price of HDFC Bank, let's say, reaches 1600, will you go and exercise, or will you go and use your right to buy then? No, right? Because you can buy HDFC Bank from the market at 1600 rupees. Why would you go and execute your contract at a higher price? You would never do that. But let's say tomorrow HDFC Bank reaches 1800, right? Then you have a right to buy at 1700. Then you can easily execute it and make money. The seller will have to sell you HDFC Bank at 1700 itself, even though the current market price of the stock has reached even higher. Right? This is broadly how a option, especially a call option, works. Now getting into the strategy that we deployed. First, we bought 550 quantities, or one lot worth of HDFC Bank shares. Right? This 550 quantities represents one lot of HDFC Bank. One lot means this is a package, or the minimum ticket size, in which if you want to go buy a future of HDFC Bank, or if you want to buy or sell options, this is the lot size, right? So we bought 550 quantities of this stock in cash, right? Nothing magical here. We just plainly went and bought 550 quantities, added it to our portfolio. Why? With the hope that the stock is a good, fundamentally good stock, right? That is the first thing that you need for a covered call strategy. You need a fundamentally good stock. Please note that down. So we are treating it like a commercial property, right? A commercial property which can eventually, over the long term, if everything goes right, like a fundamentally good stock, it can give us good, sweet return. Stock has a chance of moving up very well over the long term, right? Not in the term of 1 to 2 months, 50% returns. That's not what we are looking for. It's a Nifty 50 company. It's one of the largest companies in the country right now, and it has a potential for a good movement over the long term. And after buying this 550 quantities, we added an extra 1 lakh rupees into this account, and we started selling call options. And where we started selling 1700 call options. So what is happening here? So in the case of HDFC Bank, or whenever you're buying a stock, there is three things that can happen. The stock price can move down, it can consolidate, or it can move up. Right? And what we did by adding this extra 1 lakh is, even if the stock price is moving down, we'll be making money. If the stock price is consolidating, we'll be making money. If the stock price is moving up to a certain extent, we'll be making good money. But then the upside could be limited. Right? That is what is happening in a covered call option, right? Or a covered call trade strategy. So what's happening here? We bought a certain quantity of stock, then we started selling calls in it. So the stock is like our commercial property. The premiums that we are collecting as an option seller, again, as you might know, option sellers have a high probability of profit. The house always wins, right? That's how the saying goes. So as an option sellers, we'll keep collecting the premium, and in case the stock moves down, what will happen? We'll make money on the call options that we sold, right? Because that call option, as a seller, if the price does not reach that level, that entire premium amount is going to be a profit for me. If the stock consolidates as it is doing right now, we'll be making money, right? An extra rental income, as we are calling it. And if the stock price is moving up, not up till 1700, still will make money. If the stock price crosses at 1700, what will happen? This is where the fun part of a covered call happens. So selling a call option is technically you, as a derivatives trader, having the obligation to sell whatever the underlying is. Right? So since our underlying and our call option sell position is in the same instrument, right? It's HDFC Bank calls itself that we are selling. The trade will be cancelled out. So technically there's a lot of things that go behind the scenes, but you do not have to think about any of that. Once the price of the stock crosses a 1700 mark, right? You, as a call option seller, you have the obligation to sell. So you will be selling that stock which you have in your hand. At how much money? Even if the stock is moving up to 1750 or 1800, you'll have to sell it at 1700 itself. But we bought it at 1500. So anyway, it's going to be a net profit for us, right? Right? You see the beauty of it, right? There will be an upside, but the upside would be limited. And in the case of a normal consolidation in the stock, as we are seeing right now, or small up moves over multiple months, very slowly over multiple years, we'll be getting that rental income that we were talking about. And in the case that HDFC Bank randomly moves up 20% in 2 days, in the upcoming 2 days, what will happen? There is not going to be a loss for us, right? The stock will move up and we'll get certain profits, but we'll not get unlimited profits, right? Our profits will get capped at that 1700 mark. That is all how the strategy works. It is a covered call strategy. Your profits are capped. It is covered with a call option. So we'll quickly get into the mathematics of it as well and see how it works out, right? How much percentage or ROI you can expect from this trade. So as we said earlier, the beauty of it is you do not have to look at your screens at all. You do not have to actively manage your positions. You do not have to worry about any of that. So first, what happened here? We bought a certain quantity of HDFC Bank, which is coming out to 1500 into 550 quantities, right? 8.25 lakh worth of a commercial land, commercial property, or in this case, HDFC Bank shares is what we bought and added to our portfolio. And from there, we added an extra 1 lakh so that we can sell call options. So to sell call options, you need an additional money, right? So we added that capital and we started selling call options. So call options, what we are currently getting a premium or what we are collecting a premium is around 8 rupees for a 1.5 month period. So simplifying it, over the course of 1 year, we would get nearly 64 points, right? 64 points is what we would collect on the call option. 64 points into 550, which is a lot size. So the expectation is that we'll collect somewhere around 25,000 to 35,000 as premiums over the course of 1 year in HDFC Bank. So you tell me how much the ROI is. I would look at it this way, right? The HDFC Bank is a long-term real estate portfolio of mine, which is growing steadily over the long term. I can expect it to grow, and it is a purely investment play. And on the other side, the extra 1 lakh that I added for selling this call option is generating me nearly 20 to 30%. So it is kind of beating any commercial property returns in India all over, right? But if you do not want to look at it that way, you want to look at the combined ROI as well, then you can look at it that way as well. So if you're dividing this amount which you're getting with the total investment which we have put in, which is 8.25 lakh for the stock and plus 1 lakh extra that we are putting in for doing the covered call, it will come down to nearly 3.8%, 4%, right? Not great, but still for a commercial property, around 4 to 5% is what you can expect in India. In a really good case, you might go up to 6 or 7%, but we'll get to how you can get there as well, right? I've not counted the underlying property appreciation or the stock appreciation here. I'm just talking about this premium collection divided by the entire money that we have invested, stock plus whatever money is required for the call option selling. Now let me tell you one additional factor which we have used to make even more money on this trade. So the entire 8.25 lakhs that we have invested into this HDFC Bank, you can pledge it, right? And you can pledge it, you can get 90% of margin on that since it is a Nifty 50 stock. And with that pledge margin, you can do anything. If you want to do intraday trades, you can use that entire money as margin for your intraday trades. If you want to do positional trades, you will have to add certain amount of cash as well. You can run a completely different strategy. I'm not even talking about this covered call and the profits and the underlying here, right? So that 8.25 lakhs, if you are able to run an intraday strategy on the margin of nearly 7 lakhs that you get there, and if you are able to make, let's say, 20% returns or 15% returns on that extra capital that you have deployed, you can just do the calculation very easily, right? So what all are happening here? One, the HDFC Bank stock, right, which we are hoping for a capital appreciation over the long term in a very small amount here. Then we are getting the dividends on that stock. Then we are doing this covered call strategy, which will hopefully make good returns for us over the long term, and we wouldn't have to liquidate or sell our HDFC Bank, right? In the case of the stock moving up really high. And then with the amount that we have bought HDFC Bank for, again you can pledge it and then you can use it for trading as well. So yes, beautiful strategy. Now you might be very interested. So I'll tell you the advantages and the disadvantages of it. First, we'll start with the advantages. So the advantages are all that we've discussed. It has a lot of possibilities. You can get into any stock which is FNO enabled. You only have to look at, you have to buy the exact lot size in which the FNO is there. You have to invest a good amount of money into that stock exactly for the lot size in which the futures and options of that stock is being traded, and you can start using this covered call strategy. strategy. Also, you can pledge the underlying for any margin for further trades. So these are generally the advantages of it. So you can treat it like a commercial property and as a rental income as we are treating it. Again, it's just a term that we are using for us to digest it more well. Now, what are the cons of this strategy? So what if you're investing or buying that stock at a very high price? So that's where the importance of getting the stock at a right price comes in, right? Technically you're making the biggest investment on that stock itself, right? The extra 1 lakh, the extra whatever money that you're adding, the extra trading money, that is all going to be very, very small amounts of money. But your big chunk of capital is going to be in that stock in which you're buying. So you'll have to make sure two things. This is where a trading mindset comes in. So first, you'll have to make sure that you're buying the stock at a really good price, right? For us, in the case of HDFC Bank, it was at a good price, 1500. We saw good supports nearby. It had a recent fall and we thought, hey, we'll go ahead and invest in it. The downside from here is limited because it's a good company, fundamentally good company. There is value in there as well. So even though the stock might not immediately move up, there is lesser chance for the stock to move down or crash down without any reason. And the second disadvantage is at a situation where the stock shoots up really well, right? And you'll have to liquidate that stock or sell off that stock. As a call option seller, you have an obligation to sell. Let's say HDFC Bank goes to 2000 by the end of May. We'll have to still sell HDFC Bank to whoever has bought our call option at 1700 rupees. So hope that is clear. Unlimited profit of a normal equity trade, that is not there, right? But what is the realistic chances for that? You can also think about it and let me know in the comments down below. Third disadvantage is that if you're using pledged amount, right? If you're buying that underlying stock and you're pledging it, and let's say you go into a loss situation where the stock, as we said, it will be liquidated. In that case, you'll have to make sure that your stock is being unpledged on time. Please make sure this is done. Otherwise, you would go into a margin call and into a lot of trouble. So you'll have to unpledge before the exact settlement happens by the end of the month. Only then you'll be safe. And four, it's not really a disadvantage. It's more of a warning, right? It's not so easy to deploy a trading strategy, right? The question of where to sell call option comes in, right? The basic thumb rule is that sell a call option wherever you think that the stock will not go, right? And that's how we ended up selling 1700 call options. And in our case, we might be moving it around a bit, right? You can choose to not move it at all. It is a May series that we are trading in right now. And the premium of the 1700 call option in May has reached down to 2.5. So we might choose to either bring down that strike price, right, to maybe 1650. Right? Or if we think that is too risky, then we'll go into a June series and once again start selling 1700 calls. Right? So you will need that trading mindset. It is not a strategy for beginners. It is a strategy for whoever who does not want to worry about what will happen if they forget to look at the screen. And coming into the fifth point as well, this is being used by HNIs as we talked about in the beginning of the video itself. Since it is being used by HNIs, there is a high capital requirement for the same. The strategy requires high capital and that matter can be somewhat a problem for a lot of people. So if that is the case, you cannot deploy it yet, but you can think about accumulating a stock over a long term, and the extra 1 lakh cash is all you need. Let's say you have 300 quantities of HDFC Bank already. You'll have to buy some more quantity plus add 1 lakh so that you can start trading this covered call. And also one rule, this stock needs to be a Nifty 50 company, a very fundamentally strong company ideally, and then its futures and option needs to be very active, right? That's why we chose HDFC Bank in the first place. So you hope you can understand all of this concept. So that's it for this video, guys. If you like the video, make sure you get liked and subscribed as well. And if you have any doubts about the same, make sure you drop a comment down in the comment box as well. As always, this is Ajay Ajith signing off. See you in another video. Bye bye.